Now I can say welcome. Thank you. There. All right. Why don't we start with a motion to approve the minutes from previous meeting?
I move that
Thank
we
you.
approve the minutes.
Thank you. Any discussion or changes? All in favor?
Aye.
Thank you. All right. Next thing on the agenda, is there anything?
Can we do a roll call just
Oh,
so we
sure.
can take the minutes?
Oh, I'm sorry.
That's okay.
Um,
Alan Robbins.
Okay,
Ted Isaacs.
okay.
Mike Rodenberg.
And perfect. Thank you very much. And Councilmember Carl is on with us on Zoom.
He didn't have to deal with the traffic.
Oh, we have a council meeting tonight, so he-
Hopefully,
Yeah. Between now and then, I will be there.
and hopefully it'll be
Yeah.
emptied.
all right. Thank you very much. Other than that, on the agenda is the Marquette financial update.
Who are those guys?
Can I just, on behalf of the pension, we send our condolences.
Thank you. I appreciate it. I appreciate that and
Spotted.
glad to be here.
Mother.
Oh, I'm sorry to hear that.
Thank you.
My condolences.
Thank you. So we have obviously the report through the end of the fourth quarter. So we got the year in the books and obviously good news, well over the assumed rate of return. So that helps kind of compared to some of your peers out there who have more in US equities and more in large cap. Those plans, in this type of environment where large caps dominated, those are, obviously those funds are going to outperform in this environment.
Can I ask a question?
Please.
Do we make up for 22?
You make up for it? Well, let's see.
No.
I'm just kidding. No.
No. Put that on.
Still digging
No.
out. So yeah, 2022 was down 13.1, 2023 was up 11.6. And obviously, the law of numbers, you got to dig out even harder to get back to square one. But the year before was 13.5% positive. The year before was 12.6. The year before that was 19.5. And I go on, I digress. So if you go to exhibit 1, this is just the initial report. And obviously I'm covering this, but kind of the more important thing is kind of like probably the final discussion on asset allocation, either do or don't.
Mhm.
And good news is your current allocation gets you well above from our long-term expected returns above your assumed rate of return. And our kind of homework was to kind of look at a potential portfolio that is kind of a near term and then future state, if you're so inclined, of a kind of a model portfolio type thing. So exhibit 1, page 1 shows you obviously the current lineup. Everyone is in compliance. You have your friends from Principal, friends from Vanguard, and then a couple others that we've sprinkled in there through the years, Pacific Partners Group, and so forth. Page 2, flipping over, you can see market values at the end of December. Total market value 21,955,811. You can see obviously all the various allocations. Probably no surprise, we're a little outside of target with this most recent quarter on fixed income. You pull benefits from your core fixed income, and equities obviously shot up considerably during the quarter. So not a surprise for us at least. So going down the list there, you can see all your various allocations. So maybe we just jump to performance 8 and 9. So you can see for December, the fund was up 4.0, a little behind the benchmark, which was 4.2. So obviously that is just allocated like your target indices. You got caught by the accident too.
Yep.
Yep.
Yeah, it was
It was bad.
We were talking about, we weaved around, but.
So then the number beneath that is your ranking. So those are against public defined benefit plans in the universe. So you see 76th percentile. So about 3/4 of the funds out there in this universe were better. Why? And if you go over the next couple, you can see 92nd and 95th. Why? As I said, US equities, many of the funds in your kind of sub 50 tend to go pretty heavy on US equities. That's kind of been a thing there. The median allocation of those types of funds is closer to 50%, and you have about 40%. So if you have that much difference, and if equities kind of go crazy, you are going to lag in that environment. Also, obviously, you have real estate. Not all plans have that, and in this environment this year, that lagged. So kind of combine those two, and that's kind of the quick and dirty on that. So for the year, like I said, the fund was up 11.6. So you go back in time there, you can see kind of the rolling returns. Past 5 years, average annualized was 8.2, 7 years, 7.1, and so forth. Fixed income for the month, quarter, and year, you can see very strong compared to the aggregate benchmark, as well as compared to your peers. Obviously, some very good numbers there. Going down the list, obviously, you have principal. Overall, pretty good performance, kind of relative to the overall benchmark. The principal core plus on the year did lag compared to many of the peers out there, but in the most recent time period, very good rankings there. Going back in time, both the core as well as the core plus, have done a good job, and obviously that's what we need because we do have some assets in there. We need to keep assets there overall. Then you see preferred securities. That's one of the ones that we will be talking about. You can see on there, obviously it's added value through the years, but obviously that just injects equity-like risk into your fixed income. Now you have high yield, obviously still. You have floating rate debt, which has been a great addition in this environment. You see up 13.9%. So one of the things that we're talking about is maybe can we kind of cut out that preferred securities and do something else with it that kind of helps the overall portfolio. U.S. equities, you can see the mix for the month was good. You are overweight, as we talked about the past couple of meetings and through the years. You've been overweight small cap and mid cap versus large cap and versus the overall Russell 3000. If you recall in December, when everyone was kind of hoping and wishing for the Fed to cut in March, small caps love that news. And we saw a big resurgence there so far this year. We've kind of given that back a little bit on the small cap front. But you can see overall for the quarter, just a little ahead of the benchmark. And then the 1 year is the big underperformance compared to the benchmark, just because, in mid cap value, you see that obviously it's an index fund, but that was only up 9.8. And you kind of go further down the list. If it wasn't in large cap or large cap growth, you were probably going to lag the overall indice. And we kind of talked about that before. So not uncommon for anybody that's not doing a full straight index or making some kind of bet on large cap. Top of next page, non-US, good way to end the year, 5%. So the quarter up 9.4 and then 13.9 for the year. Also indexed here with our friends at Vanguard. So you obviously have the total international stock index for the year that was up 15.5. On small cap, that was up 15.1. So we did see very strong small cap internationally versus large cap. Haven't really seen that in a while. And then emerging markets did lag. China, as probably most of you that follow, has been the laggard there. And then real estate, continues to provide some pain in investment portfolios. So hopefully the pain is decreasing. That's hopefully been a theme we've been seeing the second half of the year. You can see principal for the quarter was down 2.4 and ended the year down 11.1 versus 12.8. So in this tough environment, at least this year, they have protected a little bit compared to the index, which is comprised of their peers. Then you have Partners Group. You can see for the quarter was up 0.7 and the 1 year of 8.3. In a normal year, 8.3, obviously from an alternative is appreciated, but obviously any money that you took out of U.S. equities and put into private equity last year, obviously you made a trade there for that particular year that, you missed out on, 26% of a S&P 500 return during that year. But on the whole, you look at the overall benchmark that they're up against, it definitely pays off in the long run. So that continues to be, a place that we're positive on.
It's the reason why the fund since inception is 6.5 is because we weren't in the whole year.
Correct.
Okay.
Yeah, that's just since
Since
January. So it's
right
during the month of January,
Gotcha.
not like Gen 1.
Yeah. Okay.
Mm-hmm. And then last but not least, cash, getting a little bit of return there. Past year, you got 3.5% from the region's cash. So obviously, that number has been a lot higher than it has been in basically since 2006. Cash about $58,000.
Oh, so it's diminished.
De minimis. Basically, it's
Okay.
it's there to cover their fees and not have to like each meeting say, hey, we need to raise
Fine.
$4,000. So we keep that low. So that's the run through. Obviously on an absolute basis, we'll take it. Relative to your benchmark, you're right there. But I said the peers that, tend to put a lot more into US equities and let it ride. This was their year overall. And Jonathan, let's have Jonathan just give you kind of a quick run through on kind of that partners group. I know we don't talk about it too much, but just kind of a quick summary on kind of what they have going on there.
Thanks, Tom. Yeah, as you all mentioned, yeah, you invested in the fund in January 2022. Since inception, it's had a 6.5% annualized return as of the end of November, just due to those statements being slightly lagged. Overall, it's we categorize it as private equity, but there's a lot more in there than that, and it's extremely diversified compared to your closed-end style private equity funds. So on page 29, you'll see a few different breakdowns here. You see it's diversified geographically across North America, Europe, the Asia Pacific. It's diversified across transaction types, directs, primaries, secondaries, and listed assets, as well as by sector on the bottom and by vintage here. One item that we cannot fit on there, just because you can only fit so much on one page there. There is a breakdown by asset class as well. It is a majority private equity. It's about 70% private equity, 13% infrastructure, 12% real estate, 2% private debt, and 3% listed / public assets in there. So overall, it's been a pretty decent addition to the portfolio, even though you didn't catch quite as much of the upside in 2023 compared to public equities. You did protect well on the downside during 2022. So, kind of a give and take there, yin and yang. But overall, very well diversified across geographies, transaction type, and by asset class as well.
And the last part of this report for your minutes, you flip over to page 30 for your fees. And on there, you can see the first blue line going across is the investment managers. And you can see that is about 33 basis points, so 1/3 of a percent. So all in on the roughly 22 million, you're paying about $73,326 annually for those investments. And that number on the far right in blue is the industry median. And that is just those types of investments, those types of vehicles, taking the median of those as apples to apples as best as possible. Then you have our fee, and you have Regions fee, and that all adds up to that number on the bottom. Any questions on the fourth quarter?
Nope.
Okay. Main event, Exhibit 2. So goal here, like I said, is kind of continuing the conversation that we've been having just on asset allocation. Like I said, go, no go, that's your call on that. Page 2 just kind of summarizes some kind of just observations, discussion points to kind of set the stage here. So first one, so we have kind of 2 targets here. The near term is something that could be done kind of now to get you to the future state. Long story short, now if you wanted to reduce your real estate, you couldn't. And as I think all because there's a queue to exit. We are seeing queues start to free up a little bit, even principal. We're starting to see a little bit of that free up. So we will start to see that open up. But if we wanted to pull out, $500,000 of real estate right now, it's wait in line at this point. So near term, long term, obviously, anything that we do here, we have to be mindful of the benefit index cushion. So anything that was done here and things that we didn't do that didn't make the cutting board here, that was ones that maybe, mess with the benefit index and it brought it down too low. That certainly would not be comfortable. We did keep the overall fixed income allocation at 30%. I think about a lot of your peers, some of them that maybe had higher targets kind of throughout the past 4 or 5 years, kind of got their fixed income targets even kind of below 20%, some of them. All those plans are starting to ramp back up to 25, 30%. So you're already at 30%. Don't really see a need to put more into fixed income at this point. You're kind of at a nice level for kind of where interest rates are right now. Next bullet point, as I mentioned early on, preferred securities. So, looking at kind of the different investments and kind of the risk return trade-offs and kind of your overall portfolio. This contemplates removing the preferred securities. Obviously, that is a principal investment. So just got to be mindful of the benefit cushion on there, which we were. And then the last bullet point we talked about, I think it was last meeting or the meeting before, just your overall portfolio to get your assumed rate of return, instead of knocking down your fixed income to 20% or 15%, in order to make the numbers work in our system, you had an overweight to small cap and EM, because those just model as they always have forever. Not that they always happens and turns out that way, but those tend to model higher returns overall. At obviously the trade-off of more volatility within there. So what we're looking at here on page 3 is some of the output. Instead of making you go through that huge model that we did last time, we just kind of stuck to the basics here. So you have the different asset classes on the far left, what grouping they are in. So you have fixed income, US equity, non-US, and then kind of your alternatives at the bottom. The overall expected return, the 10-year forward-looking expected return from the most recent time period we ran this. So you can see core is at 5.09. That number 2 years ago was around 2%, just because of where interest rates were at that particular time. And you go down the list, you can see different allocations. So you can see the preferred stock at the bottom of that fixed income group, 6.11%. What we didn't add on here also is the volatility, just to kind of keep this all on one page. But volatility for something like that would be a lot higher than some of the other fixed income allocations. Going down the list for US equities, you can see all the various expected returns. As I said, expected returns highest in small cap. Small cap's been the most beat up. And just in general, it tends to model at a higher return. Non-US tends to model a little higher, especially with the recent run we've been on of US outperformance versus non-US. That tends to model a little higher, but the trade-off obviously there would be also volatility. And then down below, we have the alternatives. You see core real estate modeling at 6.42, and then private equity from a fund of funds, which would be the structure that you're in, would be just a little under 11% overall. So the current column, that's your current targets. So obviously that's not real time. Some of these numbers are obviously moving around, but your current targets are there. Down below, this is the output from our model. So your current average annualized 10-year return from your current portfolio is 7.92%. And the average annualized 10-year volatility is 10.88. And then that last number on the bottom of the page, beneath that, 0.73, that's just the return over volatility, just to kind of get a feel for kind of how much return you're getting, the volatility that you're injecting into the portfolio. So the higher you can get that number, at least to us, and keep your return up, generally the better. That probably means more alternatives. So there is a limit to reality on these kind of things. But you can see right now, if you do nothing, obviously you're modeled to hit your assumed rate of return and then some. Back to the top again, we have the near-term target recommendation and the long-term target recommendation. The near-term target option A, which we could be done as soon as you want. You can see we've removed the preferred stock. That's 4%. That's no more. And we bumped up core bonds by 2, core plus by 1, high yield by half, bank loans by half. Other things that we did on the US equity side of things is increase the large cap core. And then kind of longer term, instead of having a mid cap growth and a mid cap value index fund, because remember those were remnants of when you had active managers in each and were doing that dance. Just find a dedicated mid cap core index fund, mid cap and small cap as well. The S&P 600, I don't know if I showed you guys some data on that at a prior meeting a couple times ago, but S&P 600, that particular index has a little more quality skew versus the Russell 2000. It's beat kind of the pants off it for the past 20 some years. So I would like to see if we could talk about that as a possible replacement for just having Vanguard small growth, Vanguard small value. And then further down on the page, basically my bottom bullet point on the discussion points is just reducing some of that overweight to small cap and overweight to EM and bumping that up to your just broad non-US overall. The near term does not touch any of the alternatives, does not touch core real estate because we can't in reality. And then private equity also sticks at 5%. What that does in the near term, it does reduce the expected return by a little bit to bottom below 7.85. Volatility does get knocked down to 10.52. So your utility actually goes up for the overall portfolio, a little bit there. And then I do have in gray the impact to the cushion. So we ran this with your current values to the benefit cushion. It actually increases your cushion in the near term by about $50,000 with the current targets. And then option B is, okay, let's say we get to a point where we can open up and get the real estate funds out. We still are fans of real estate, but not necessarily at 10% of the portfolio at this time with interest rates where they are. So this contemplates knocking down real estate from 10 to 7. Obviously, remember, we also have to always be mindful of the cushion. So we taking it to 5, then your cushion, we looked at it with 5%, then your cushion gets down into the low hundreds overall, and it gets really low. So 7% was about as far as we could push it to taking money out of principal that we felt comfortable. So at this point, we have private equity going up to 10%, so getting from 5 to 10%. And then if you go a little further up, some of that coming from equities to get to basically top that off. So what that does to the portfolio from an expectation standpoint is it increases your long-term target up to 8.03 and the volatility of 10.63. So compared to where you are now, your return would go up, your expected return would go up, and your expected volatility would go down, and that utility is up to 0.76. In gray, again, the impact to the cushion, it would get your cushion to about 500 to 600,000 at this point, which I think still is comfortable for everyone. It doesn't totally negatively impact you from that standpoint. Right now, you're about 1.2 million. So obviously the cushion has run up, but we assumed about 500,000, 600,000 was probably the low end of comfort to try to get you a different portfolio, not stress the cushion too much. And basically what's left then in that at principal is obviously your core fixed income, your core plus, your high yield, and then 7% in real estate at that point. So you've I guess further de-risked your what you have left at principal, because obviously you've removed preferred stock and then you've reduced real estate a little bit as well with that move. Let's see. I have other stuff that contemplates further discussion, but I will pause because I just talked a lot there. And obviously other option is do nothing, which plenty of people do.
Anybody have any questions? I guess if we can get the portfolio to grow, meaning that it grows more than what we take out and we get back up, we could just continue to not put any more into real estate, which would lessen the percentage as well.
Yeah.
Which would be
Absolutely.
the other alternative.
Mhm.
Is all of our real estate tied up?
Yes. Yes, they, like I said,
I should say it's illiquid without, I mean, there's,
yeah, I mean, principal is starting to send out, kind of, okay, we'll give you 5 or 10% of what you've asked. If you asked for it 2 years ago or whatever it might be, it is loosening up a little bit, but for now, it's still pretty liquid. And that's not just them, other.
no, I understand,
Yeah.
yeah, yeah. Yeah, no, I think that, I like option A. And I think we should move to trend option A. I think the long term of option B would be more of a, as the years go by, to try and figure out if, how things go and if we want to tweak.
Mhm.
Would be my recommendation. We'll start with A and figure out B. Not that
So-
there's much difference between A and B. but go
Yeah,
ahead.
so I was asking, that.
Yep.
So for B, are you suggesting though that we? start-
Can you turn your mic
Oh,
on,
I'm sorry.
please?
Yeah, I was getting yelled at too.
That on? Yeah. Okay, so for option B, were you suggesting that we start implementing that now though, by getting in queue with real estate? And so what would the time frame between A and B be in your minds?
So I think you already do have a partial redemption in for real estate. That is still forthcoming because you are over target even on the 10%, even with real estate going down. Your current real estate allocation is 11.1%. So your target is 10. So you will keep getting some.
What is our redemption request right now?
What's left?
500,000?
The 500 was the initial. So it's gotta be 500. We haven't,
Say, well, I think you guys maybe got like 20 or 30 grand out in at the very end of,
not in,
sorry, January.
okay, it's not contemplating this. So you've gotten a little, so call it 470 is left, and principal is very flexible on these things. So if it gets to a point where, let's say that 470 number is too high, we say, hey, we rescind half of that or whatever. They're very flexible once the queue kind of loosens up. They're flexible. Right now, prior a couple of years, they weren't that flexible.
Flexible meaning they just don't let anybody have anything.
Yeah, they have a giant queue in, which
Mm-hmm.
is, they have some very large pension plans, international pension plans they've committed all the documents to put in some very large sums. So they're kind of waiting for things to, I guess, calm down, but.
Gotcha.
So would we be better off putting more in the queue?
I
guess that way anyway.
500 would take you, let's see,
What do we have?
We have 2.4.
that would take you down another 3%.
So then you're back down to 10%.
10%. And if
Yeah.
the objective is to get to either,
Yeah, but you gotta be mindful of the quotient,
after Michael, what?
of the quotient of the formula. You
Yeah.
take too much out of principal, you either have to put it into bonds with principal, or you have to leave it in the real estate or you
Right.
buy something else, because you gotta be mindful of that.
So if the roughly 500 came out, your real estate would be down to about 8.6%. So you'd still be okay cushion wise. You'd be trending closer to that 7% target, which I thought was kind of, reasonable, but kind of push, kind of the outer limits of kind of probably where you want to be on your cushion.
If we didn't have cushion issues, what would you take the real estate to? What would be your recommendation?
5 to 7, we'd probably be talking private credit a little bit as well to diversify there.
Mhm.
But yeah, I mean, real estate with interest rates where they are, the trade-off on real estate is minimal. I mean, there's still portfolio diversification, which has been helpful through the years many times. But yeah, 10% is definitely on the higher end of things.
Okay.
And I think Mike also brought up prior meetings, obviously. So right now you're overweight private equity. I think it's 6.7 versus 5. And, obviously that's not something that we're tapping, from a liquidity. We just gotta, it takes time to get that money. But it's not something that we're tapping at this point in time. So that will kind of naturally,
We started with how much?
500.
It was 5% target. Your initial investment.
Like 1.5. wasn't it?
Was it?
Like 1.25. or
1.25 perhaps, if somebody sounds right. So that, you know, is being that that's kind of outside of your principal, outside of kind of your initial liquidity.
Could be 1.25. Could it? I
It's
mean,
up to
Yeah.
1.476 right now. I think it was 5%, which would.
Okay.
Yeah.
Then that's, okay.
Yeah,
Yeah,
so
okay.
that will kind of drift upward at some point. Obviously, if it drifts upward more and more and more,
Well,
then
again, hopefully that goes up, but hopefully
everything goes up.
everything goes up.
Correct. Correct. Not just large cap stocks, not
Right.
just 5 stocks.
Well, hopefully the portfolio goes up is what I mean,
Well, yeah,
right?
Yeah.
And then this percentages go down.
correct. Denominator effect. So obviously this year, you know, portfolio was up, so that's good. So if you just want to look at from an implementation standpoint on Exhibit 3, played around with this. The first, I don't have page numbers on this, but the first, you know, we call it rebalance page at the top. This is as of January 31st, because this is with the last meeting in mind. If no asset allocation changes, if your decision today is to stand put, we have it.
Well, let's do this.
Okay.
Let's take it step by step.
Okay.
And then we don't have to waste our, you know,
Sure.
doing that. What does everybody feel about? Should we have a motion and then discuss?
Yeah.
That?
Makes sense.
Okay, does somebody want to make a motion?
I'll make the motion
Okay.
to implement today, right?
Mhm.
Into asset allocation option A.
Nice second.
Perfect. All right. Any other discussion or any questions about that? No. Okay. All in favor?
Aye.
Aye.
Any opposed? Good. All right. So that's our plan,
Okay,
objective. So let's go into
how do we do it?
what that, yeah, how do we do it?
Okay, so, yeah, so within Exhibit 3, flip it over. Top of the page says City of Olivet, January 31st, 2024, with asset allocation changes.
Mhm.
Okay, so get your bearings here. So you have the managers, the current amount, the current mix, so what the current percentage is, the target mix, and this was the part that has been changed to what you just approved.
Mhm.
That plus minus column is what needs to be done to get there. And then filled out the suggested changes column, which is busy, because obviously we changed a few things this time. And what gets us there? You will notice that, you know, the principal US real estate, nothing is there because we're not doing anything. Also, I just want to note, we have a couple numbers, and you highlighted probably in red, just to alert them, maybe, I don't know. Is you're really, once again, as always, you're really close to that 5% breach on fixed income, because you use fixed income to pay benefits. So as part of this, also bumping up your fixed income to kind of replenish that. So the suggested changes column is very busy. But what it does is get you close to your new targets, bumps up your fixed income, but obviously we're not touching real estate right now because we can't. Partners Group is still over target. You got that little bit of cash down below, which is like 57,000 and change. And these actions get you to that.
So my question to you.
Yes, sir.
We had talked about finding, wait, not we, but you.
Yes.
For funds to put things in.
Yes.
Instead of going growth and value.
Yes.
Should we be doing that now? Or is that too many steps? You talked about an S&P 600, that, should we do that now, or is that too many steps?
I mean, you could. I don't have materials with me now, so I didn't.
Well, we could approve these changes to
Yeah.
go in that. And you could come back and say, in making these changes within mid cap, we have this amount, we want this fund instead of splitting it 50-50.
Yeah, you can do whatever
I
you
guess
want.
it's gonna be Vanguard index funds, right? Just a matter of.
Yeah.
Which market, which index is tracking.
I mean, is that your preference? If
That
we
is
said-
mine, yes, to get out of it's kind of silly,
Right. I
but I
agree.
mean, there was a reason,
I
but
understand.
I'm not discounting that,
Right.
but at this point, you know, as long as we're making some
Because
changes.
I would make a motion to approve this asset allocation change based on the percentage or dollar amounts. With giving you leeway to change the funds
Great,
within that asset allocation,
that'd be great.
that you think best. That you think will do best, right? Yeah,
Yeah,
We
so
can-
just
we
that,
can-
that,
We can grant them that, right?
I think we,
Essentially
You can
discretion.
amend your motion.
well, no, this
So-
would be a new motion. So we approved the asset allocation. This would be a motion to approve the changes.
You
funds.
didn't vote on the asset allocation. I don't think.
Yeah, we did.
Yeah.
We just did.
You voted?
Yeah.
Oh, I do things quickly. Sorry.
Unanimous.
Mike made the motion and Shannon seconded.
You
it. That's what I thought.
seconded, but that's not a vote.
Yeah.
And no,
we
they're
haven't
not
voted.
voting.
then.
Then I asked for any discussion or any other questions and I said all in favor.
All in favor?
I'm
Okay,
sorry.
so that's fine. We have the recording in
I
case
know.
I'm
Be
wrong.
correct with videotape.
Is this like you're gonna throw the red flag and then we're gonna basically go back and listen to it?
Not today. Not today. Yes, you could make a second motion that would give them the leeway to look at those indexed funds instead of the growth in the value.
Okay, that was my plan all along to do. So thank you for the clarity
You're welcome.
and I apologize. I
No problem.
went fast on that. So, all right, so
Guess that's my question though, is
Yeah.
that we're giving them discretion to find the funds.
We
And
can-
Is that within the IPS essentially?
well, maybe we can do is we can report back via email, just say this is the plan. Is that acceptable?
it works for me.
Yeah.
I don't,
It's
you know,
fine
as
by
long
me, I
as
just
we're,
want to make sure we're not violating IPS. or anything.
Yeah.
yeah, I mean, you're
I-
picking the funds within the asset allocation that we approved.
Yeah, I'd say for non-discretionary clients where it's kind of like, okay, execute this and pick something. It'd give us more comfort if we could just email it to everyone and say,
Yeah.
this is, any objection to this or this, and we'll outline the fund with a ticker and fee and all that.
I got a question.
Yes, sir.
If high yield, your expected return on high yield is better than real estate.
Mhm.
And the cushion percentage is higher for high yield than it is for real estate. Why would we not use high yield more than we are?
Volatility overall, just kind of how it models in a portfolio. So when we do different, I mean, I played around with it, 7% in this, 8% in that, and there's kind of thresholds within the correlation of the asset class, all the stuff that we don't see, but it's all built into the model. So kind of once you start pushing it on some of the allocations, then kind of the volatility shoots up and it looks worse as a
Okay.
portfolio.
That's all right.
I mean, it's a good question, just kind of based on how principal looks at things,
Right.
from a
right,
measurement
yeah,
standpoint. I mean,
So does somebody want to restate or should I just go with the motion that I said or should we restate it?
Let's go with the motion that you said. Go ahead and restate it though. if that makes-
It doesn't matter to me. So the motion is to approve the asset allocation changes with the caveat that you will email us with your suggested funds to purchase
mid cap, small cap,
Within the asset.
within the
class.
asset classes.
Right.
yes.
Right.
For mid cap, small cap, those would be the two.
Yeah.
The US.
Mid and small, right?
Are you gonna do mid and small? Hang on. Yeah, that's fine.
That's it. Everything else you have in place. Yeah.
That you like. Everything else you like.
Yeah. I mean, you got the lowest fee Vanguard funds.
Okay.
Second,
Any questions or discussion? More discussion?
No discussion, let's vote.
All right. All in favor?
Aye.
aye.
Any opposed? Any abstentions? Excellent. All right.
Okay, thank you. We'll get cooking on that and get
Great.
report back.
Well, thank you very much.
Thank you.
Is there any other questions?
Yeah, well, I
Yeah,
didn't
please, go ahead.
still, sorry, I didn't really
Yes.
get answered before. What's
Yes.
your thoughts, ours or yours on the option B? The timing, if this is your long-term, what are we talking, what does long-term mean?
So long-term, and that is more not necessarily our choice right now, because we can't
Right, right,
pull out all this money from real estate. Longer term could mean next year at this point, could mean end of this year. I assume it wouldn't be 2 years, it would be
okay,
catastrophic.
Yeah, I think that it's there's a handful of moving parts. And I don't think there's plan B is not much different than plan A. Because I
It's just
think,
because of the real estate.
well, it's the real estate, I think we have to make, decide if we're gonna put more into private equity. We might not be able to put more in private equity because the fund stays where it is and the private equity keeps growing. It might be 7 or 8% anyway, and we say we can't, we don't wanna.
So
put
for
more-
now, we're just gonna
Yeah.
monitor
Yeah.
Correct,
quarter
that
over
would be,
quarter and
comfort.
not put any more in the queue. Is that,
Yeah, sounds
Yeah,
like, because, yeah, I mean, and obviously, these are targets and you
Mm-hmm.
have, you have bandwidth on all of these and, if the 500,000 request comes in, let's say in a quarter and says, yeah, we could pay it out right now. I'd probably go to you guys and say, this would get you under target. I mean, we're
Right.
okay with it. Are you okay with it?
okay,
right, that's a whole nother discussion.
yeah.
Yeah, but
Okay.
that's a
Yeah.
hypothetical.
Another thing too is that currently you're already at 6.7%.
On the
private
partners,
equity.
right, I know,
Yeah,
that's what
yeah.
I'm saying
It's
is
gonna
that,
grow organically.
Yeah. So
Yeah.
maybe more.
No.
so, that's why I said, I hope the fund value grows. We get back to 25 million, obviously. That will grow also depending on who grows faster. So, yeah.
Yes,
there's-
well, so maybe just go to jumping, I know, are we out of?
No, go ahead.
So if you go back to exhibit 1,
Mhm.
page 5, I actually skipped this, jumping to performance. So this is always looking at the dollar. So this past calendar year started at 21.6, over 2 million, so almost 10% out. So you need to get, at this point, you need to get 10% to kind of break even, to grow the
Is
fund.
that gonna be consistent, Darren? Darren,
I'm sorry.
is that gonna be, are we gonna lose 2 million? Net every year?
It should be, I think it's around like 150.
150.
So it's 1.8 million.
We just lost the old chief too.
I think there was some large, I feel like there was some, 'cause I went looking through the principal stuff and there were some larger things.
So that helps us,
Chief
right?
Hal.
That helps us.
I mean, I
Oh,
don't know,
I
I don't know
mean-
if there's a survivor benefit, but
10 years there.
that was I love the guy, but that was honestly my first thought too.
Yeah. So I mean, we've really taken a hit over the last 3 years just because of, yeah, just
Yeah.
money coming. I mean, if you're giving, if 10% is coming out,
Yeah.
it's hard to, how much do we put in every year,
About 600,000, 650.
each year? Yeah, I mean,
Just
so you gotta
make
come up
them
with
30.
1.2.
Put it usually it's in here. I usually put in what we collected in December, in December, but that wouldn't be reflected. So about 325,000 went in the first week of January. We'll see about 350 go in final weeks of June. That's the city's collection. So that would be reflected here.
Okay, that would be in the following year.
But so wait, the net cash flow is not what we've put in, correct?
Net cash flow is.
So you put in 600 last year and they took out 2 million, so it was,
2.6 million years ago.
At least for us, for what we see in our reporting is from principal.
Right.
So money in, money out, the net amount that we saw in principal was 2 million out. Darren said, I guess, early January, there was some money put in, like, and that was for December, that was for December.
yeah, but it should be, it should
Every,
once you do a year, it should be.
yeah, so we go 3 years, 5 years, that's, I guess, that schedule, but there are obviously, when there's larger retirements, there's more, it's not just flat 150, if I saw, right? There's lumpier.
Because of the arrangement of the cash value portion of it, typically people take their lump sum and not convert it to the annuity.
So we're seeing, so net cash flow could be a larger lump sum.
Minimum of 150 per
Okay,
outflow.
okay,
And if another way to look at it, the city puts in about 3 months worth of expenses and the rest of it has to come from the current holdings. We collect
right.
about 3 months worth of pensioners' payments, and that would not include any lump sum or retirements. Any retirement.
So what is the annuity that gets paid out every month? Do you know that?
154,000.
Right, but does that include, that does not include lump sums?
No.
That's your point. Okay, so yes, you're 1.9 million.
I don't mean this in an insensitive comment, but Chief Hal passing away a couple weeks ago. He was probably a large one, wasn't he?
I'm pretty sure this is all public.
Yeah, we don't have.
you
Let's
have
just
to-
say, let's just say it's not going to have a net effect
Okay,
because of his beneficiary choices.
got it,
Gotcha, okay,
understood.
yeah. Because if we're trying to, you know, if we have 8% coming out net, that's a tough nut to overcome with what we've got. So, long term. Anyway, just observation,
7.5%.
at least.
Yeah,
I don't even know if 7.5% will do it.
Tax rate though.
Well, I know what they do. Yeah, uh-huh. All right, well, that's scary. If it gets down to 14 million, you're taking over his chair. I'm out of here. I'm not taking the heat anymore. All right. Thank you, sir.
Great, thank you.
Yeah,
Thank you.
all right.
Hey, look at the bright side. You don't have to report to the city council.
That's right.
that is a good, do you have to be a resident of Olivet to be on this?
I think so, yeah.
Okay,
Yeah.
You moving?
I don't know. No comment, huh? No, thank you.
All right, is there anything else on the agenda that we have?
No, I don't have anything else.
Okay. Anybody have anything that they want to discuss about this? All right, motion to adjourn,
Second.
meeting get down. I love that part. All right,
All right, thanks, everybody.
thank you.
Thank you.
I got you over before 6, so you can have your meeting.